ParthKuchana.com, complete fundamental and technical analysis of stocks and other financial industry updates. Hello, welcome to Partha Kuchana Finance channel. This video provides complete fundamental analysis of Adani Enterprises Ltd ADANIENT stock. Disclaimer: this analysis is for educational purpose only. This is not financial or investment advice. Make financial and investment decisions on your own. Valuation. Let's focus on assessing return on capital, equity efficiency, overall pros and cons, and valuation and calculation of key ratios and interpret them. This is based on market cap, current price, high-low, ROCE, pay ratio, book value, face value, financial ratios data. Fundamental analysis of Adani Enterprises Ltd. Company overview. Adani Enterprises Ltd is a diversified company with business interests in mining, integrated resources management, IRM, infrastructure, airports, roads, rail metro, water, data centers, solar manufacturing, agro, and defense. With a market cap of 3,46,355 crores rupees and a current price of 3,038 rupees, the stock has seen a high of 3,744 rupees and a low of 2,142 rupees. Key financial metrics. PE ratio, 83.4. Book value, 343 rupees. Dividend yield, 0.04%. ROCE, 9.87%. ROE, 9.73%. Face value, 1 rupee. Pros. The company has delivered good profit growth of 42.8% CAGR over the last 5 years. Debtor days have improved from 48.4 to 37.1 days. Promoter holding has increased by 2.11% over the last quarter. Cons. The stock is trading at 8.86 times its book value. The company has a low return on equity of 8.33% over the last 3 years. Return on capital employed, ROCE. ROCE has improved from 5% in March 2013 to 10% in March 2024. This steady increase indicates that the company is becoming more efficient in generating returns from its capital employed. A ROCE of 9.87% is generally considered good, though it's essential to compare this with industry benchmarks for a more accurate assessment. Return on equity, ROE. ROE has seen fluctuations but stands at 9.73% in March 2024. While an improvement from previous years, it remains relatively low compared to the industry standard. This indicates that while the company is generating profit, it might not be utilizing shareholder equity as efficiently as possible. Price to earnings, PE, ratio. With a PE ratio of 83.4, Adani Enterprises is trading at a high multiple of its earnings. This suggests that investors are expecting high growth in the future. However, such a high PE ratio could also indicate that the stock is overvalued compared to its current earnings. Book value. The book value per share is 343 rupees, with the stock trading at 8.86 times its book value. This high price-to-book ratio suggests that the market has high expectations for the company's future growth and profitability. Face value. The face value of 1 rupee indicates the nominal or par value of the stock. It is primarily used for accounting and doesn't affect the market value directly but is a fundamental metric for understanding the share structure. Conclusion. Adani Enterprises Ltd has shown strong growth and improving profitability, reflected in its increasing ROCE and ROE. However, the high PE ratio and price-to-book value suggest that the stock might be overvalued. The company's efficiency in managing debtor days and the increased promoter holding are positive signs. Yet, the relatively low ROE over the past few years indicates room for improvement in utilizing shareholder equity. Overall, while the company shows promising growth potential, investors should be cautious about the high valuation metrics and compare these with industry standards to make an informed decision. Financial health. Let us focus on financial health and leverage analysis. Review asset and liability management and equity changes. This is done focusing on assets, liabilities, equity, key metrics from the balance sheet over the last several quarters. The balance sheet analysis of ADANIENT reveals key insights into the company's financial health and leverage over the years. Assets. There has been a significant increase in total assets, particularly from 2021 to 2024. Fixed assets and other assets have seen notable growth. Fixed assets grew from 48,770 million rupees in 2013 to 65,978 million rupees in 2024, indicating substantial investments in long-term assets. Investments have also shown a marked increase, especially from 2021 to 2024, reflecting strategic asset allocation. Liabilities. Total liabilities have significantly risen from 111,871 million rupees in 2013 to 160,586 million rupees in 2024. Borrowings show fluctuations, peaking at 83,571 million rupees in 2015, decreasing until 2019, and then increasing again from 2020 onward, indicating varying levels of debt over the years. Other liabilities have also increased, especially after 2021, suggesting higher non-debt obligations. Equity. Equity capital has remained relatively stable at 110 million rupees until 2022, with a slight increase to 114 million rupees in 2023 and 2024. Reserves have shown steady growth, with a significant jump from 32,937 million rupees in 2022 to 38,962 million rupees in 2024, indicating retained earnings and other comprehensive income. Key metrics. The company's leverage has increased over the years, with higher borrowings and other liabilities contributing to the rise in total liabilities. The asset base expansion, particularly in fixed assets and investments, suggests ongoing capital expenditure and strategic investments. Despite the increasing liabilities, the growth in reserves and assets indicates a strengthening balance sheet, although the rising debt levels warrant careful monitoring. Financial health and leverage. ADANIENT's financial health shows a mixed picture with strong asset growth and increasing equity reserves. However, the rising liabilities, particularly borrowings, highlight increasing leverage, which could impact financial stability if not managed properly. The company's ability to generate sufficient returns on its growing asset base will be crucial in maintaining financial health amidst rising debt levels. In conclusion, while ADANIENT has shown robust growth in assets and equity, the increasing leverage poses potential risks that need to be balanced through effective financial management and strategic investments. Cash flows from financing activities. Now let's look at the trend and interpretation of cash from operating activities, cash from investing activities, cash from financing activities, net cash flow. This is done focusing on cash flow data over the last several quarters. The cash flow analysis of ADANIENT provides insights into the company's operational efficiency, investment strategies, and financing activities over the years. Cash from operating activities. There is a fluctuating trend in cash from operating activities, with peaks in 2023 at 17,626 million rupees and lower values in earlier years, such as 774 million rupees in 2017. The recent years show a strong recovery, indicating improved operational performance and higher cash generation from core activities. Cash from investing activities. Cash from investing activities shows a consistent outflow, reflecting ongoing investments. The highest outflows are seen in recent years, with minus 18,767 million rupees in 2024. This suggests significant capital expenditure, possibly in fixed assets and other long-term investments, aligning with the growth in fixed assets seen in the balance sheet. Cash from financing activities. Financing activities also exhibit volatility, with significant inflows and outflows over the years. Notable inflows occurred in 2021, 15,901 million rupees, and 2024, 8,879 million rupees, indicating external funding through debt or equity. The outflows in some years, such as 2019 and 2016, suggest repayments or buybacks, impacting the net cash flow. Net cash flow. The net cash flow has been relatively small, with both positive and negative values over the years. The fluctuations indicate varying impacts of operating, investing, and financing activities. Positive net cash flow in 2023 and 2024, 970 million rupees and 424 million rupees, respectively, suggests better cash management in recent years. Pros and cons. Pros. Strong recovery and growth in operating cash flow indicate enhanced operational efficiency. Ongoing investments suggest a focus on long-term growth and asset expansion. Positive net cash flow in recent years indicates improved cash management and financial stability. Cons. Significant outflows in investing activities could strain liquidity if not managed properly. Volatility in financing activities indicates reliance on external funding, which could impact leverage and interest obligations. Fluctuating net cash flow shows inconsistency in cash management across different periods. Conclusion. Adanient's cash flow statement reflects a company with strong operational cash generation capabilities, balanced by significant investments for growth. While the reliance on external financing introduces volatility, the overall trend indicates improving financial health and strategic investments aimed at long-term value creation. Managing the high outflows in investing activities and stabilizing net cash flow will be crucial for sustained financial stability. Revenue trends, profit margins, expense management. Let us now focus on revenue trends such as growth or decline, seasonality. Profit margins, like gross profit margin, operating profit margin, net profit margin, and expense management. The profit and loss analysis of Adanient provides a comprehensive view of the company's financial health, focusing on revenue trends, profit margins, expense management, and key profitability ratios. Revenue trends. Adanient's revenue shows significant growth over the years, particularly between 2021, 39,537 million rupees, and 2022, 69,420 million rupees, and reaching 127,540 million rupees in 2023. This growth indicates a strong upward trend, with the trailing 12 months TTM at 102,220 million rupees. The revenue trend indicates robust growth without evident seasonality, suggesting consistent performance across fiscal years. Profit margins. Gross profit margin. The operating profit margin, OPM, fluctuates, peaking at 19% in 2015 but declining to 5% in subsequent years. It rebounded to 12% in 2023 and 2024. Net profit margin. The net profit margin shows improvement over the years, with notable increases in recent years, from 788 million rupees in 2022 to 3,335 million rupees in 2023 and 4,431 million rupees in 2024. Expense management. Operating expenses. Operating expenses have generally increased in line with revenue, indicating effective cost management. However, the rise in expenses from 65,707 million rupees in 2022 to 118,722 million rupees in 2023 suggests increased operational costs. Cost of goods sold, COGS. While COGS isn't explicitly mentioned, it can be inferred from the total expenses, which are consistently rising, necessitating efficient cost control measures. Earnings before interest and taxes, EBIT, and earnings per share, EPS. EBIT trends. EBIT shows substantial growth, from 1,056 million rupees in 2016 to 6,079 million rupees in 2024, indicating improved profitability. EPS trends. EPS follows a positive trajectory from 9 rupees and 19 paise in 2016 to 35 rupees and 28 paise in 2024, reflecting strong earnings growth and shareholder value. Profitability ratios. Return on equity, ROE, and return on assets, ROA, aren't provided directly, but the increasing net profit and EPS suggest improving profitability ratios. Exceptional items and non-recurring costs. There is no explicit mention of exceptional items or non-recurring costs, implying a relatively stable core business performance without significant one-time impacts. Impact on company stability. Revenue consistency. The stable and growing revenue trend indicates a strong market position and effective business strategies. Profitability analysis. Improving profit margins, particularly the recent increases in OPM and net profit margins, indicate effective expense management and operational efficiency. Earnings trends. The consistent growth in earnings, reflected in EBIT and EPS, demonstrates the company's ability to generate sustainable profits. Conclusion. Adanient shows a strong upward trajectory in revenue and profitability, with effective expense management and increasing profit margins. The positive trends in EBIT and EPS indicate robust financial health, making Adanient a potentially attractive investment. Ensuring consistent cost control and maintaining the growth momentum will be crucial for sustaining this positive performance. Overall performance, growth trends, profitability, and operational efficiency. In this section, let us focus on highlighting overall performance, growth trends, profitability, and operational efficiency. Provide insights into the company's financial health and potential future outlook. This is done based on trends and growth, profitability and margins, operational efficiency, profit before and after tax, earnings per share, EPS, details from quarterly earnings reports over the past several quarters. Trends and growth. The quarterly sales data of Adanient reveals a noticeable growth pattern. Sales saw a substantial increase from 12,579 crore rupees in June 2021 to 40,844 crore rupees in June 2022. However, there is a marked decline in subsequent quarters, dropping to 22,644 crore rupees in June 2023 and stabilizing around 25,472 crore rupees by June 2024. This indicates significant seasonal or market-driven fluctuations, with peaks around mid-2022 and subsequent stabilization. Profitability and margins. The operating profit margin, OPM percent, shows variability, starting at 6% in June 2021, reaching a low of 4% in June 2022, and then improving to 15% by June 2024. This fluctuation suggests that while the company faced periods of lower profitability, it managed to enhance its margins significantly in recent quarters. Operational efficiency. Operating profit exhibited a general upward trend, starting at 796 crore rupees in June 2021 and peaking at 3,706 crore rupees by June 2024. Expenses also rose but were managed relatively well compared to sales growth, indicating improved operational efficiency. Depreciation expenses increased steadily from 126 crore rupees in June 2021 to 934 crore rupees in June 2024, reflecting potential investments in long-term assets. Profit before and after tax. Profit before tax, PBT, followed a similar trajectory, improving from 380 crore rupees in June 2021 to 2,232 crore rupees by June 2024. Net profit showed a significant rise from 266 crore rupees in June 2021 to 1,772 crore rupees in June 2024. The tax percentage fluctuated, affecting net profit but remained relatively stable towards the latter quarters. Earnings per share, EPS. EPS data indicates growth with some volatility. Starting at 2.47 rupees in June 2021, it peaked at 16.57 rupees in December 2023 before stabilizing around 12.76 rupees in June 2024. This trend suggests overall improvement in earnings, albeit with notable quarterly variations. Conclusion: Adanient's financial performance shows significant growth and improved profitability over the analyzed quarters. Despite facing fluctuations in sales and margins, the company demonstrated operational efficiency and a strong upward trend in profitability. The increasing EPS and stable profit margins suggest a positive outlook for the company's financial health. This analysis indicates Adanient is on a robust growth trajectory, with potential for continued financial strength in the future. Company stability and competitive positioning. In this section, focus is on current market price, price positioning, price-to-earnings ratio, PE, valuation comparison, growth expectations, market capitalization, size and stability, investor confidence, dividend yield, dividend %. Income generation, company strategy, net profit, profitability comparison, profit trends, quarterly profit variation, growth volatility performance trends, sales, revenue scale, revenue consistency, quarterly sales variation, sales growth, market trends, return on capital employed, ROCE %, efficiency and profitability comparative performance compared to peers in the same industry. 1. Current market price, CMP hours. Adani Enterprises, CMP 3038 rupees and 20 paise, is significantly higher than its peers, indicating a premium market valuation. This could reflect strong market confidence or higher growth expectations compared to its competitors. 2. Price-to-earnings ratio, PE. Adani Enterprises has a high PE ratio of 83.35, suggesting that investors have strong growth expectations. However, this also indicates that the stock might be overvalued compared to peers like Aegis Logistics, PE 44.31, and Redington, PE 12.55. 3. Market capitalization, market cap. Adani Enterprises leads with a market cap of 3,46,355.14 crores rupees, dwarfing its peers. This indicates its dominant market position and greater investor confidence in its stability and growth potential. 4. Dividend yield, %. Adani Enterprises has a very low dividend yield of 0.04%, suggesting that the company reinvests most of its profits for growth rather than returning them to shareholders. In contrast, Redington offers a higher yield of 3.26%, appealing to income-focused investors. 5. Net profit, NPQTR. Adani Enterprises' quarterly net profit of 1,772.26 crores rupees is the highest among its peers, reflecting strong profitability. This is a positive indicator of its operational efficiency and market strength. 6. Quarterly profit variation, QTR profit var %. Adani Enterprises shows a significant quarterly profit variation of 115.93%, indicating substantial growth. However, such high variation can also suggest potential volatility. Comparatively, Honsa Consumer has an even higher variation of 1,115.59%, pointing to extreme profit volatility. 7. Sales QTR. Adani Enterprises also leads in quarterly sales with 25,472.40 crores rupees, showing its extensive market reach and revenue-generating capability. Redington follows closely with 21,282.33 crores rupees, highlighting its competitive scale. 8. Quarterly sales variation, QTR sales var %. Adani Enterprises has a moderate quarterly sales growth of 12.49%. While Honsa Consumer, 427.17% and PDS, 23.93% show higher growth rates, these companies are starting from a smaller revenue base, making Adani's consistent growth more impressive. 9th. Return on capital employed, ROCE %. Adani Enterprises' ROCE of 9.87% is lower than several peers like Cello World, 36.28%, and Redington, 19.46%. This indicates that Adani might not be as efficient in generating returns from its capital compared to these competitors. Summary: Adani Enterprises stands out with its high market capitalization, strong quarterly profits, and significant market confidence as reflected in its high CMP and PE ratio. However, its low dividend yield and ROCE suggest that while it is a market leader with strong growth prospects, it may not be the most efficient in terms of capital utilization. Investors might view it as a high-growth but potentially volatile investment, especially when compared to more stable peers like Redington and Cello World. Changes in promoter, FIIs, DIIs, government, and public shareholding. In this final section, let us evaluate the company's ability to generate cash and manage its financial obligations. With focus on changes in promoter, FIIs, DIIs, government, and public shareholding with the objective of evaluating stability and investor confidence. Fundamental analysis of Adani Enterprises Ltd. Shareholding pattern analysis. Promoters. The promoter holding has seen some fluctuations but remained significant, with a peak of 74.92% in September 2021 and a recent increase to 74.72% in June 2024. This high level of promoter holding indicates strong confidence in the company's prospects. The dip to 67.65% in June 2023 followed by a rise to 72.61% suggests active promoter involvement and potential strategic adjustments. FIIs, foreign institutional investors. The FII holding has decreased from 18.05% in September 2021 to 11.73% in June 2024. The initial decline indicates reduced foreign investor confidence, but this stabilized in the recent quarters. The rise to 19.34% in June 2023, followed by another decline, could reflect fluctuating perceptions of risk and return among foreign investors. DIIs, domestic institutional investors. The DII holding has generally increased from 3.87% in September 2021 to 6.02% in June 2024. This upward trend indicates growing confidence among domestic institutions in the company's performance and prospects. Public shareholding. Public shareholding has increased from 3.16% in September 2021 to 7.53% in June 2024. This gradual increase suggests rising retail investor interest and confidence in the stock. The significant rise in June 2023 aligns with the period of promoter share adjustments, indicating robust market engagement. Number of shareholders. The number of shareholders increased significantly from 2,14,588 in September 2021 to 6,43,975 in June 2024. This substantial rise shows growing retail participation and broadening investor base, which is a positive sign for liquidity and market interest. Conclusion. Adani Enterprises Ltd has shown stability and active management in its shareholding pattern, with significant promoter confidence and increasing domestic institutional interest. The fluctuations in FII holdings reflect varying international perspectives on risk, while the rising public shareholding and number of shareholders indicate robust retail investor confidence. These factors collectively suggest a stable and potentially optimistic outlook for the company's ability to generate cash and manage its financial obligations effectively. Thank you for watching. If you like this analysis, please like, share and subscribe. Also, do not forget to visit parthkuchana.com.